So you've got a limited company and you want to know how it's taxed. Well, you've come to the right place. In this video, I'm going to show you exactly how limited companies are taxed, what you need to know about them, and even covering other additional topics such as how to take money from a limited company and what can happen if you borrow money from your limited company. Fantastic video. Stay tuned to the end to make sure you get the maximum benefit from this. It's very valuable information and will help you run your business in the most efficient way. What is a limited company? Well, a limited company is most importantly a separate legal entity that's limited with limited liability. So that's the main thing you're going to be able to benefit from when setting up a limited company is a separate legal entity. So it enters into contracts in its own existence. Okay, so a limited company, even if it's owned by you as a shareholder, it exists separately from you in law. So it can own its own assets, it can have its own liabilities, and it can be sued. That's the first thing to mention. It's regulated by Companies House. That's where all of the basically limited company stuff is dealt with, and you've got Companies Act 2006, which is the law surrounding a limited company. So that's what a limited company is fundamentally. That's the main stuff you need to know. It is limited liability. That's why a lot of businesses use this structure, is because you as a director, you as a shareholder, can't usually be sued. It's the company that bears all the risk. So the only amount of risk with a limited company is its assets. Your personal home is not usually at stake as it would if you were a sole trader or a partnership. How is a limited company taxed? Well, at the moment it's just a flat rate corporation tax at 19%. So what you'll do is you'll add up all of your income for the year, less all of your expenses that are allowable. Any disallowed expenses won't be deducted as part of your tax return. And then what happens is just a flat 19% corporation tax rate is what's deducted there. So we'll do an example. If you've got £100,000 worth of profits, £50,000 worth of expenses, £50,000 worth of profits left over, you'll pay tax on that at 19%. And the payment date for this is 9 months and 1 day after your company's year end. You need to pay that over to HMRC. You also need to file a corporation tax return 12 months from your company's year end, along with accounts as well to Companies House. How should you take money from your limited company? Well, there's a couple of different ways available. The most common two are a mix of salary and dividends. So with a salary, it's a tax deductible expense in your business. What this means is it's going to come off of your profits, meaning you'll pay less corporation tax, but the salary will be taxed on you as an individual with your self-assessment tax return. So for most businesses, the current tax efficient amount, depending exactly on whether you've got other employees on a payroll, you're looking at about £9,100, potentially £12,500. The exact specifics really do depend on your circumstances. But say you're putting a £9,000 salary for each year, this is a tax deductible expense to the company, saving you that corporation tax. And if it's your only income so far, that will fall within your personal allowance where it'll be tax free. So that's really good so far. And then you've got dividends, the second way. At the moment, these are being taxed at 7.5%. This is going to go up in April this year with the social care levy. It's going up 1.25%. So all of the dividend bands are going up. And what you'll usually do is you'll pay dividends out of the company, but these are paid after post-tax profits. So in that example, you had your £50,000. You've now taken your £9,000 salary out of that. So you've got £41,000. You're going to pay tax on that amount. And only the balance left over that you can use to pay dividends from, because you can only pay as much as you've got in retained earnings from your company out as dividends. Anything more than this, and it's called an illegal dividend, which is basically repayable, and there are quite nasty tax implications if you don't repay that dividend. HMRC will treat it as a director's loan. We're going to cover that in a minute, so stay with me. And they're basically the two main ways, salary and dividends. With a salary, you need to make sure that you are on a payroll. HMRC needs submissions going in, unless you're taking a very, very low salary. I think it's £116 a week, maybe a little, somewhere around there. But for most people, you need that payroll in place. You need a PAYE scheme set up, because if not, you're going to fall foul of the legislation, and HMRC will give you penalties and fines. So you need a payroll in place. And with a payroll, you need to do monthly submissions, and then dividends as well. Anything you've got left from your profit after you've paid your taxes, you can take it as dividends. How is money that you've left in your limited company taxed? So once you've paid your corporation tax on the profits, you've basically got some money left sitting in the business bank account. What can you do with it? Well, if you leave it sitting there, there's no more tax to pay whatsoever. There'll only be additional tax if you were to pull it out basically as salary or dividends, or if you were just to leave it sitting there for a rainy day as a savings pot to cover your 6 months worth of operating expenses, you can do so. Of course, if you earn interest on it, there will be tax to pay on that, but let's be honest, no one's getting a significant return on cash in a bank these days. So that's all there is to it. You can leave that in there and there's no additional taxes to worry about whatsoever. How is a loan from your limited company to you taxed? So if you were to take out more money from your company than you put in, so you borrowed money and it's not been declared as a dividend or a salary, it's not been taken out via one of the official forms, what you've done there is you've borrowed money from your company, and the tax consequences here are pretty dire. So where this loan balance goes over £10,000, you'll have to start paying interest on this. So you personally will pay interest into your limited company. The rate's about 2%. It changes, I think it's 1.75 or 2.25%. So it's quite a small amount, but it's an amount nonetheless. And you need to pay this. So the money that you've got in your pocket where you pay tax on it, you've got to pay that for this interest, and it's going to go back into the company, where if you want to pull that back out again, you're going to have to pay more taxes. So it's a big, basically you want to avoid this where possible. That's where the loan goes over £10,000. And what's going to happen is if you do not repay this loan 9 months and 1 day after the company's year end, you've got some additional tax to pay there as well. You're looking at 32.5%. That's going to go up as well. And this is basically kept by HMRC up until the end of the accounting period, when you've repaid that loan or it's been released, it's been written off. So really you don't want to be getting into this situation. If you're going to borrow money from your company, look at keeping the amount below £10,000, or if you really do need the money, about 2% isn't a terrible interest rate. It's going to be cheaper than any banks. And make sure that that loan is repaid before 9 months and 1 day after the company's year end. There's a few rules you need to watch out for, so you can't have any arrangements in place to borrow the money back from your company or just to temporarily repay it and take it. These are the bed and breakfasting rules, so you can't do any funny business like that. HMRC don't like it. If you're going to borrow the money, make sure you repay it and do not borrow it again, or certainly have any plans to borrow it again until you actually definitely need to. So this is the main things you need to be aware of when it comes to limited companies and how they're taxed in the UK. I hope you found this video useful. If you do, let me know, give me a thumbs up, and let me know in the comments what you like about this channel, what don't you like. I'd love to hear from you all, and otherwise